Hello, in this video we're going to look at exercise 9-8A. In Connect, you can look inside of Connect and determine if you are looking at this exercise also. It'll say in your Connect what the exercise is. So it might say Connect problem 1, Connect problem 2, that's what you see, but if you'll look closer, exercise 9-8A or whatever the assignment is, it's there and it can be always traced back to the book. So I'm in the ebook and we're going to look at exercise 9-8A, ratio analysis. It's asking us to compute working capital, current ratio, debt to assets ratio, and debt to equity ratio. Pretty simple, straightforward problem. Before I continue in the video though, I do want to explain some of these ratios. Let's expand on them before we crunch the numbers. So current ratio, it explains current assets and current liabilities. So when you calculate it, you want a ratio of greater than 1, which would mean that you have more current assets to pay current liabilities. And again, current, magic word, means less than 12 months. So you have enough assets that are right now cash or can be quickly converted to cash within 12 months to pay debt that will need to be paid within the next 12 months. So keep in mind, current means 12 months or less, and that we're looking at the ability to make our payments over the next year. So again, the ratio greater than 1 is good. And then we have, that was the current ratio. Working capital is just current assets minus current liabilities. I'm not going to expand on that because it ties in with the current ratio, right? So if you have a negative working capital, that's really bad. And if you have a current ratio less than 1, that would reflect that you have a negative working capital amount. Anyway, so debt to asset ratio. So it measures how much the company is financing their assets by debt. So in other words, if you recall, the accounting equation is assets equal liabilities plus equity. But sometimes in these ratios, we don't do liability to assets ratio, we call it debt. So we could change the accounting equation just for the moment and call it assets equal debt plus equity. So assets equal. So how do we buy our assets? We either borrow the money or we sell stock, or the owners, if it's a sole proprietor, invest money into their company. So assets equal, and how do we pay for it? The assets, debt, and equity. Pretty cool, huh? Well, same thing for equity. So we're buying assets. Are we using equity to pay for it? Debt to equity, debt to assets. Are we using debt to pay for our assets? Gives us a good idea how we're paying for our assets. So a higher ratio for debt to assets, let's go back to debt to assets. A higher ratio could be a sign of financial risk. You see, we want to keep them, I've seen successful companies that are not equal, but it could indicate if we have a lot more at debt compared to our assets, that they could end up in trouble financially. Could be a lot more profit for the stockholders though, and it's called leverage. And you guys know leverage, or you're aware of it. If you bought a house, let's say you buy a house that's, goodness, starter homes now, they're incredibly expensive. When I was starting out, they were starter home was way less than $100,000, and it wasn't, everybody was like, wow, look at your home. We never had anything that nice when we were starting out. Now starter homes, same, not much has changed. And what are they, 200 something, 300, depending on where in the state of South Carolina. That's South Carolina numbers. If you're in a different area of the world, country, U.S., it could be much higher. But anyway, so you don't put $200,000 down on that house. You put 5% down. Let's say that's $10,000. So you invested $10,000, and now you live in a home that's almost $250,000 for $10,000. That's leverage, right? You've leveraged that $10,000, so now you can live in a home or an asset, you own an asset that's worth a lot. So 5% got you 95% more house, if that makes sense. 5% down is 10,000. 95% is what you owe. That's called leverage. So then your debt to asset ratio is pretty high. All right, which is good. You're enjoying that house, and that's a lot of times how we have to buy houses. You know, no different here. And we'll tell you, shorter term's better. Having that house paid off, anyway, we won't get into it, but you got to save for retirement too. But anyway, we'll change the subject. Back to the topic at hand. So debt ratio with leverage could be fine. A lot more profit when times are good. When times are bad, and we're getting into those times that are bad probably. Some people say we're in a recession. Some people argue vehemently that we're not. So if you adjust GDP for inflation, did you grow or not? But anyway, so the economy, when it slows, economy could be great, and whatever your company is doing could hit a bad lick. Doesn't matter if the country's in a recession or not. If your company hits a bad lick and they're very leveraged, a lot of debt to assets ratio, what was good becomes bad. It's a double-edged sword, leverage. Times are good, makes more money for the shareholders. Times are bad, could bankrupt the company. So you have to be careful. And if rates are rising and you finance debt short term, that means you either pay it off or you refinance at a higher rate. All right, so debt to assets ratio is important, and then debt to equity ratio shows that the stockholders or the owners, if it's a sole proprietor, are the ones financing the assets. Sometimes it's good to have debt. Sometimes, like we just discussed, it's bad. So you have to be careful. And these ratios give you some insights into what the company's doing. You can compare it to years prior for the same company. You can compare it to other companies in the same industry and make decisions on if that's good or not. Some entities have to have high debt to assets ratio. For instance, I work for a mortgage company. High debt to assets ratio. Has to be that way. We borrowed money to lend money out. So that's the way it was for us. So that would be an acceptable company or industry with a high debt to assets ratio. All right, so let's look at calculating them. I'm going to stop the video for a second and change over to a different screen. Hopefully you wrote down the numbers. I didn't tell you that. Maybe you should pull your ebook up, write down the balance sheet numbers, or whatever. I learned this from people. They take a snapshot on their phone and then they have it. So that's a good way too. You could do that. Anyway, you could pause the video and come back. I should have mentioned that. All right, so working capital, all you do is take your total of your current assets, subtract your current liabilities, and you get the difference, current liabilities. Oh, whoops, wrong. Already showed you the answers for 9-8A. Sorry about that. Current assets minus current liabilities is 200,000. Current ratio 600. These two numbers again. 600 divided by 400. Current assets are always on top. Assets are always on top in these current ratio, or quick ratio, or the acid ratio, or all the other ratios similar to that. So 600 divided by 400. 600,000 divided by 400,000 is 1.5 times. And the book will do 1.5 to 1. You'll hear me say 1.5 times. We need to do probably what the book is doing, because that's, probably better for consistency. But you might see it written as 1.5 times, and that's how I was taught. All right, so that means there are 1.5 times more assets than liabilities. So 1.5 to 1, 1.5 to 1. So that's your 1.5 and that's your 1. Either way, it works. Debt to assets ratio, total liabilities divided by total assets. And it says it in the right here. There's your formula. Pretty cool, huh? If you look at it that way, total debt divided by assets is what we did. and I get 64.0. Now, when Connect says round to the nearest decimal, first decimal place, whatever it says it in red bold, do so or you will get it wrong. Okay, they're serious about the rounding. And if you think about it, a lot of times we're told to round to one digit in our financials, so this is good practice and a good way to do things. And total debt to equity, again, the equations given to you in the name. Total liabilities divided by total stockholders' equity, so it's 1.8 to 1, or 1.8 times. All right, so this is it. This is the first problem of Module 3, Assignment 2 homework.